Today on Go Ahead Ask, there have been numerous proposed tax policy changes that could affect 1031 exchanges, self-directed IRAs, self-directed individual 401k plans, and defined contribution plans or 401k plans. So today, let's get an update on where we stand. Let's unravel that today on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to the Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate to provide investors with better quality information so you can make better informed investment decisions. I'm Bill Exeter, Chief Executive Officer of Exeter 1031 Exchange Services and Exeter Trust Company. I'll be your host today. The Exeter Group of Companies includes Exeter 1031 Exchange Services that serves as a qualified intermediary or accommodator for all types of 1031 exchanges in all 50 states. It also includes Exeter Trust Company that serves as IRA custodian for self-directed IRAs and self-directed individual 401k plans, as trustee for title holding trusts or land trusts, and as agent for specialty holding escrows or custody services. As always, we encourage questions here on Go Ahead Ask. So if you have questions or topics you'd like us to cover, email us at ask@exeterco.com or call us at area code 619-239-3091. If you love Go Ahead Ask, please like it, subscribe to it, share it, and comment on it. We always respond to comments. Today on Go Ahead Ask, the topic is unraveling the mystery of the proposed tax policy changes that may affect 1031 exchanges, self-directed individual 401k plans, self-directed IRAs, or defined contribution plans, also known as 401k plans. It's interesting to note, this is actually the 100th year anniversary of Section 1031 of the Internal Revenue Code. So 1031 exchanges have been around 100 years. And there's always threats every, say, 3 to 5 years of some type of tax policy change that may impact 1031 exchanges. And this time around, it's been no different. So what does the 1031 exchange allow investors to do? It allows them to sell real estate that's been held for rental investment or business use and defer their federal and state capital gain taxes, depreciation recapture taxes, by reinvesting in other property, other real estate that's also been held for rental investment or business use. And they've been able to do that now for 100 years. And we'll cover the proposed changes at that point on 1031 exchanges. Second is retirement accounts. Retirement account investors have been able to use their self-directed IRAs, their self-directed individual 401k plans to invest in non-traditional assets, sometimes referred to as alternative assets, for years, actually since 1974 when IRAs actually came to be. This includes real estate and real estate related assets. And real estate related assets could also include or do include real estate, promissory notes secured by a deed of trust, promissory notes secured by a mortgage, tax lien certificates, limited partnership interest, limited liability companies that may own real estate, and many other types of non-traditional or alternative investments. The Build Back America Act or Build Back Better Act for 2021 is continuing to change and kind of grow with the House Ways and Means Committee. And there may be significant impacts against 1031 exchanges, self-directed IRAs, or self-directed individual 401k plans, as well as defined contribution plans or for just your larger 401k plans. So with that, we're going to unravel that mystery today. We're only talking about the proposed changes that would affect 1031 exchanges, self-directed IRAs, or self-directed individual retirement plans. The bill at this point is about 2,000 pages. So it is a huge legislative bill pending before Congress. We're only going to focus on a very, very small section of that. So first, we always get a lot of questions about the self-directed IRA topic. So first, if you're interested in more information on IRAs itself and self-directed IRAs, we've got a couple of episodes we've done in the past that address those. So the first one was episode 10, where we kind of went into the basics on self-directed IRAs and self-directed individual 401k plans. Then we had episode 16, and that focused mostly on buying promissory notes or notes such as deeds of trust, mortgages, and those type of investments, what we call paper, inside of the self-directed IRA or the individual 401k plan. And the last one we did was episode 23, and that kind of went through the mechanical steps of exactly how to buy real estate inside the self-directed IRA, with very specific details on the purchase and sale agreement and escrow or closing processes and things like that. So if you're interested more in the mechanics of using a self-directed IRA to invest in non-traditional or alternative assets, you may want to look at those 3 episodes. Today, we're just talking about the proposed tax policy changes that could affect 1031 exchanges or self-directed IRAs. So first, let's focus on 1031 exchanges. Lots of good news in there. Very easy to summarize. The good news is our goal was to educate members of Congress, congressional representatives, and their aides in terms of what is a 1031 exchange, how does it work, how do investors think, how do they approach the 1031 exchange, and to get them to understand that many investors just would not sell if they could not do a 1031 exchange transaction. So it's a huge, huge impact on the real estate market if they were to significantly restrict or limit the ability or even eliminate the 1031 exchange itself. And the good news is we were successful as an industry. The industry has a very large coalition with a lot of different trade groups involved, and we were able to get all of it removed. None of it was ever included inside of the bill, and that was our primary goal. It's a lot easier to get it excluded from the bill. Once it's in the bill, it's harder to get it removed. So the good news is none of the proposed changes to 1031 exchanges were included in the original write-up. We have had 2 revisions of the bill since the initial markup or write-up of the bill, and none of those include the revisions to 1031 exchanges as well. So the good news is no proposed tax policy changes that would affect 1031 exchanges are included in the current version of the bill. It's always possible they could add that back. It's unlikely at this point, but we'll try to keep you informed as to any changes that might affect 1031 exchanges. So with that, let's focus on self-directed IRAs. A lot of folks have been asking when they listen to our couple of updates in the past as to why this has come up. Why is it affecting the IRAs or retirement accounts? Why has it come up now? And it's really perceived abuses, I think, is the biggest reason. If you go back to some of the presidential races, Mitt Romney's $102 million IRA made headlines. And more recently, Peter Thiel, who is the founder of PayPal, he has a $5 billion IRA, and that has made the news recently. And so I think those are probably the 2 examples that have kind of fueled this ongoing attempt to limit and restrict how large, how involved your self-directed IRA can be. So we wanted to kind of focus on that. The Build Back Better Act of 2021 continues to advance, of course, in the House Committee on Ways and Means. It's not final by any means. It came out about 2 months ago. There's been at least 2 revisions since. The last revision that came out was on November 3rd. So it's very fluid and changes can occur up until the time it's passed. But it does include some tax policy changes that will impact retirement account owners. So kind of here's where we're at today. The initial version of the bill included numerous provisions that would significantly and actually drastically impact self-directed IRAs and individual 401k plans. The next revision that came out, which was the latter part of October, the last week of October, all of the proposed tax policy changes for retirement accounts were completely removed. So we thought time for celebration. Then the next revision came out on November 3rd, 2021, and they added back some of those provisions that had been deleted. So we wanted to kind of summarize where we were at today. So I'm first going to go through what has been taken out or what is out of the bill. In other words, not added back. Then we're going to go to the topic of what was added back into the bill and what is currently in the bill. Keep in mind, this is also a 2,000-page document. We're only covering a very, very small part of this. So first of all, what's out of the bill? The good news is the provisions that were going to prohibit IRA holders, IRA owners, from investing in securities if the security required the account holder to be accredited, that was not included. To me, that was a big one. What it really said was if you have an IRA, it's a self-directed IRA, and you choose to acquire an asset inside the self-directed IRA, and the requirement to buy that asset required you as the account owner to be accredited, or what they call as an accredited investor, meaning you have a net worth of at least $1 million, excluding the value of your primary residence, then you were going to be considered a prohibited transaction. That was not added back into the bill, so it's currently not in the bill. So that's good. You can go out and you can still acquire assets that require you to be an accredited investor. It also had provisions that if your IRA already had those type of assets inside the IRA, that you've already made that investment, that you would have a 2-year window to divest yourself of those assets. That was not added back, and so it's not currently in the bill. So that's good news, because those were probably the two big ones that would impact the self-directed IRA world. Would have significant impact, not only on the investor, but on companies that are trying to raise capital to start or launch a new or expand an existing business operation, which would, of course, limit the amount of new jobs that were created. So there's a lot of potential issues there. The provision that was going to limit the IRA from holding more than 10% of a non-public entity was not added back into the bill. So it's not currently in the bill. So that's good. There's a lot of IRA holders out there that own an interest in a company that's not publicly traded and they own more than 10%. Or maybe they own part of a company where they're also an officer of that company, and that was not added back into the bill. So it's not currently in the bill. So that's good. There was also mandatory provisions, or a mandatory auto IRA provision, I should say, where the company, most businesses, would have been required to either offer some type of a retirement account or an auto IRA savings arrangement, associated employer credits, savers credits, things like that. And that was not added back to the bill. So it's not currently included in the bill. So those are the ones that are out of the bill. I think those are all really good news, especially for the self-directed IRA holder, because many, many investors look for those types of assets. We're going to take a quick break for a message from our sponsor, and when we come back, then we're going to talk about what was added back into the bill. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net. And we're back. We were talking about what was not added back into the bill and what, therefore, not in the bill currently. So now let's cover those items that were removed with the first revision and now added back during the second revision, so we know what we're still looking at. So one of the items is the $10 million cap, if you will. It doesn't affect, obviously, a whole lot of people, but there are investors who spent 30, 40 years focused on building their retirement accounts, especially their self-directed IRAs, and they built up assets that are worth well over $10 million. Spoke to a specific client last week whose combined traditional IRAs and Roth IRAs are valued at about $20 million. So this obviously directly impacts him. In his case, he said, I've spent 30 to 40 years focused on my IRAs. I didn't really build a lot of assets outside of my retirement accounts. So this has a significant impact on him. Effectively, what it does is if your aggregate value inside of the IRAs is $10 million or greater at the end of the last or prior tax year, you'll be required to take some distributions out of that. Fortunately, that was originally targeted to be effective January 1st. The effective date has been pushed out to 2029, so we've got about 8 years or so before this actually takes effect. There's also some provisions in there that would eliminate some of the tax consequences if there was a required distribution because the value of your account was too great. So at least they've added it back, but they've eased some of the terms a little bit. Would still like to see it completely eliminated or at least grandfathered in, but it'll remain to be seen whether that happens or not. It also would have required or would have prevented or prohibited future contributions to traditional IRAs, Roth IRAs, SEPs and Simples, et cetera, if the value, the aggregate value of your retirement accounts exceeded that $10 million mark. So that doesn't affect a whole lot of people, but it is critical. It is unfortunate because there are some folks who've worked really hard to build up their retirement account, and now they're going to be penalized for that. So with that, that's kind of the area that covers that $10 million cap that a lot of you have probably heard about. There were provisions that eliminated Roth conversions for the after-tax amount contributions in 2022 and all contributions to a Roth IRA for higher incomes. That was added back into the bill, but it's not effective until 2032. So we got some time to plan around that. We'll see where that goes. Again, the bill is not final, so there's all sorts of potential changes that could still happen. There's also a current statute of limitations of 3 years, so that if your IRA engages either intentionally or unintentionally in any type of a prohibited transaction, the IRS has a 3-year statute of limitations, and after that 3 years, they can't audit or go after the IRA. The proposal is to extend that from 3 years to a 6-year statute of limitations, so it gives the IRS almost really double the amount of time to enforce those type of issues and go after prohibited transactions. Another provision that was added back into the bill is a provision that treats the IRA owner and the beneficiaries, if the IRA owner has passed, as disqualified persons for purposes of prohibited transactions. Not a huge issue, but we do have to pay attention to that. We don't want to set up the IRA to do transactions or do business with a beneficiary that could effectively make it a prohibited transaction either now or in the future. And there's also a provision that was never removed from the initial bill. So it was included in the bill. It still remains in the bill. And that's a provision that prohibits IRAs from investing in domestic international sales corporations or foreign sales corporations. So DISC, D-I-S-C, or FSCs. And that continues to be in the bill. So that's kind of a quick recap. The good news, which was the biggest one we were really worried about, is the ability to invest in any type of security where the IRA holder had to be an accredited investor, and that's been eliminated or not added back into the bill. So that was the good news of all of this. The $10 million cap is unfortunate, but fortunately it doesn't affect a whole lot of people. So there's a lot of good news in there. We're still trying to get some of those things changed or removed. That's a quick recap on where we're at today with the proposed tax policy changes that would affect 1031 exchanges or self-directed IRAs or self-directed individual 401k plans, or even 401k plans. So the larger 401k plans are what we just call defined contribution plans. So with that, thank you for listening to Go Ahead Ask podcast. We very much appreciate it. We have not tagged what our next topic will be. Because we're waiting to see if this actually becomes final, then we can have our next podcast covering exactly what was included in the bill. If not, then we'll have another topic. One of the topics we're looking at is discussing selling land, dirt, unimproved property, and exchanging that into improved property with a focus on things like net lease properties. As always, if you have questions or topics you'd like us to cover, please email us at ask@exeterco.com. or call us at 619-239-3091. You can also reach Exeter Trust Company at area code 307-222-8750. If you like our podcast or even love our podcast, please like it, share it, subscribe to it, and comment on it. We do reply to all of the comments. Let us know what topics you'd like to hear from or hear about next, and we'd be happy to cover those. Thank you again for joining us today. Look forward to next time.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.